Oil is screaming higher, the Middle East is on fire, analysts are throwing around $200 a barrel as if they are discussing weather, and gold, the one asset ordinary people are taught, should rise when the world begins falling apart, just had one of the ugliest stretches it has seen in decades. If that sequence feels wrong to you, good it should, because that feeling of something not making sense is exactly where bad decisions begin. People see war, they expect oil up and gold up, they see oil up and gold down and assume either the textbooks were useless or the market has gone mad. That is where investors get punished, not because they are unintelligent, because they stop at the first layer of the story. And the first layer is almost never where the money is made. I want to walk you through this carefully because what is happening right now is not just another geopolitical headline. It is a chain reaction. It is a money mechanism. And if you do not understand the mechanism, you are going to make the kind of move people always make in the middle of a genuine stress event. You will either panic or you will freeze. And both reactions are expensive. I have lived long enough to know that most people do not lose money in a crisis because they lacked access to information. They lose money because they saw the event, but they misread the order of effects. They focused on the headline and missed the transmission system underneath it. That is the real danger now. The transmission system. So let us begin where the transmission begins. Geography, the Strait of Hormuz is not a symbolic place. It is not merely one of those foreign names Americans hear when the world gets tense and then forget when the news cycle moves on. It is a choke point in the most literal financial sense. A narrow, absurdly important corridor through which roughly a fifth of the world as seaborne oil flows. That is not a side detail. That is the entire story. Most people imagine an oil crisis as though it requires some dramatic final event. A full closure, a headline saying the route is shut, a formal declaration of catastrophe. That is not how markets work. Markets do not wait for the last possible confirmation. They price disruption when disruption becomes probable enough to change behavior. And behavior is already changing. That is the part most people miss. You do not need the strait to be fully closed for oil to become a global problem. You only need it to become dangerous enough that the economics of passage start breaking. That is where insurance enters the picture. And insurance is one of the least appreciated forces in global finance. People think tankers move because captains are brave and governments are powerful. They move because insurers decide the risk is insurable at a price the business can still bear. Once the risk crosses a threshold, the math changes. Even if the U.S. Navy escorts tankers, even if the route remains technically open, even if no one on television is yet willing to say the word blocked, if insurers step back, premiums spike, and operators decide the route no longer makes financial sense, the practical result is the same: less flow, less confidence, more panic, higher price. That is how modern disruptions really work, not through some theatrical, movie-style closure, through the economics of fear. That is why I keep telling people that markets are predictive. Markets do not ask whether the worst outcome has already happened. They ask how much risk must now be priced before the worst outcome becomes economically real, even without becoming physically complete. That is what we are seeing in oil. And this is not some wild fantasy. History gives you enough precedent to keep your feet on the ground here. The Iranian Revolution, the Gulf War, the early shock after Russia invaded Ukraine. These were not random price spasms. They were warnings about what happens when energy flow becomes uncertain enough that the market begins paying for fear before the actual shortage fully lands. That is why $200 oil is not a conspiracy slogan. It is an extreme scenario inside a historically recognizable range when a major fraction of the world's supply chain becomes unstable. But here is the crucial point. Whether oil actually touches 200 is not even the most important question. The more important question is what happens to everything else if the market only starts behaving as though 200 is possible. That is where portfolios get hit. That is where systems start repricing. That is where central banks lose room. And that is why this matters even if the absolute peak never arrives. Oil is not just gas at a pump. This is another childish simplification people make. They hear higher oil and think about filling a car. That is the smallest layer of the story. Oil is transportation, shipping, agriculture, fertilizer, plastics, chemicals, manufacturing inputs, cold storage, aviation, defense logistics, and because energy sits inside nearly everything, higher oil is not one inflation line item. It is an inflation engine. It moves through the system faster than many polite models want to admit. That is why the market now has a problem, a serious one. The Federal Reserve came into this period with a narrative already built. Inflation had cooled enough that the public had been trained to believe easier policy was coming. Cuts were supposed to be part of the next chapter. That expectation sat underneath a great deal of the optimism in stocks, in rate-sensitive assets, in growth narratives, in real estate hopes, in corporate financing assumptions, and in the general American belief that the worst part of the tightening cycle was behind us. Now, oil has entered the scene hard enough to disturb that story. And once oil does that, central banking becomes much more uncomfortable. Because the Fed cannot simply pretend energy inflation is irrelevant if the market begins to believe it will bleed into everything else. Higher oil means higher inflation pressure. Higher inflation pressure means fewer cuts. Fewer cuts mean higher rates for longer than the market wanted. And higher rates for longer are poison to a great many things people bought under the assumption that easier money was just ahead. That is the first major chain reaction. Oil higher, inflation risk higher, Fed trapped, rates higher than expected. That is bad enough. But the trouble is it does not stop there. Higher rates do not just change policy language. They change the cost of capital. And once the cost of capital changes, the market starts reevaluating the economic assumptions underneath entire sectors. The data center boom, the AI build-out, infrastructure, spending, property valuations, long-duration growth names, heavily levered projects, anything whose economics depended on money being cheaper than this. That is why I keep telling people that what looks like an oil story quickly becomes a valuation story. Borrowing becomes more expensive. Profits become harder to justify, discount rates go up, future cash flows become worth less in present terms, and the market marks that down. That is what destroys stock prices, not a moral opinion about the war arithmetic. Now, here is where the story becomes even more interesting, because most people at this stage expect gold to be the hero. That is what the textbooks taught them. Crisis, war, oil shock, inflation risk, surely gold must rise. Instead, gold fell hard. Silver got hit even worse. And if you do not understand why, you are likely to make the wrong move with precious metals from here. So let me explain it the way I would explain it to someone. Sitting beside me at a trading desk, gold is not only a safe haven, gold is also priced in dollars. That matters. If crisis pushes the dollar higher in the short run because the market interprets the inflation shock as a reason for the Fed to stay tighter, then gold becomes more expensive for foreign buyers. That alone can put pressure on it. Now add a second force. The Gulf states and other players in the region are not operating in a vacuum. They have capital needs, liquidity needs, defensive needs. If oil volatility and conflict create pressure on reserves, spending, funding, or market stability, then some of the same actors who might normally be buyers of bullion can become sellers of bullion for reasons that have nothing to do with the long-term case for gold. That is critical, because forced selling is not the same as a broken thesis. It simply means cash is being prioritized in the short run. Now, add a third layer, paper gold. The retail investor loves paper gold when the line is going up. ETFs leverage products, vehicles that let people feel like they own the metal without having to touch the real thing. These products are not evil in themselves, but in a fast leverage sell-off, they become a problem. If gold drops and someone is sitting in a 2 times or 3 times leveraged product, then the percentage loss is magnified. That creates margin calls. Margin calls create forced selling. Forced selling pushes price lower. A lower price creates more margin stress. Then more forced selling arrives. That is how an asset that should go up can still get hit hard in the short run. The mechanism is liquidation, not disbelief. And liquidation is one of the most misunderstood forces in markets. People see an asset falling and assume the asset itself must be discredited. Often what they are really seeing is that somebody somewhere needed cash faster than they needed conviction. That is a very different thing. I have seen this so many times that I no longer find it surprising. Good assets get sold for bad reasons in crises. That is one of the defining features of real stress. In 2008, people sold what they could, not only what they wanted to sell, in every sharp event. The market starts by punishing liquidity before it starts rewarding analysis. That is why gold falling during a panic does not automatically mean gold has failed. It may simply mean gold was liquid enough to sell. Now, I want to pause here and make a distinction that matters enormously. There are 2 kinds of selling. There is structural selling, where the long-run reason for owning something has actually deteriorated. Then there is mechanical selling, where people are unloading positions because the system is forcing them to. A great deal of what we saw in metals fits the second category much more than the first. That is why I remain interested in gold here. Not because I need a fantasy, because the long-run case for gold was never just about one neat week of geopolitical fear. It was about debt, fiat credibility, central bank behavior, reserve diversification, policy response, and none of those forces disappear simply because a panic creates a violent short-run repricing. In fact, if the next stage of this sequence becomes policy support, then the long-run case for gold may be stronger than before, even if the short-run price path has been humiliating. That is what most people do not understand. They look at the price and think it tells them the entire story. It does not. The story is in the mechanism. Now let us keep following the mechanism because it leads to the most important part of all. At first, the market sees higher oil and thinks inflation that hurts rate-sensitive assets, metals, and anything priced for easier money. But if oil rises far enough or remains disruptive long enough, the market stops thinking only about inflation. It starts thinking about recession. That is the pivot. That is where the real opportunity begins to form. Because once the market decides the growth damage from oil is worse than the inflation damage, the bond market starts behaving differently. Yields stop rising cleanly. They may begin falling even with oil elevated. Why? Because recession fear overtakes inflation fear. And when recession fear overtakes inflation fear, the next policy question changes. The question is no longer, how tough can the Fed remain? It becomes, how quickly will the Fed and policymakers be forced to support the system if this damage continues? That is the policy panic. That is the part almost everyone misses when they stare only at the war. The war is the spark. The money is in the policy response. This is one of the oldest truths in crisis investing. The first-order event gets the headlines. The second-order response creates the fortune. That is why I care so much about yields. Yields tell you whether the market is still mainly afraid of inflation or whether it has started fearing the economic break harder than the inflation risk. If yields are falling while oil remains uncomfortably high, the market is telling you something profound. It is telling you that growth damage is becoming the dominant fear. And once growth damage becomes dominant, the market starts pricing not only pain but relief, not current relief, future bond buying, future liquidity, future support measures. Future attempts by authorities to stop the system from cracking under the weight of energy shock and financial tightening at the same time. That is where capital begins repositioning. Now let me make this even clearer. The ordinary investor sees war and asks, what should I sell? The more thoughtful investor sees war and asks, what should I avoid? The institutional investor sees war and asks, what will this force the authorities to do next, and which assets have already been sold too hard if that response arrives? That is the hierarchy. And if you want to stop behaving like retail prey, you need to think more like the third man, not because you will always be right, because that is where the asymmetry is. Now let us talk about positioning, because I do not want to leave you only with theory. The first obvious temptation in a crisis like this is to buy what already spiked, oil producers, the loudest defense names, anything with a ticker that fits the headline. Sometimes that works in the very first wave, usually by the time the public feels emotionally ready to do it. Much of the easy move is behind them. That is why I have little interest in chasing what everybody can already see. The more interesting area is energy infrastructure. Pipelines, storage, service providers, the toll collectors, the people who benefit from molecules moving through the system, from rerouting, from scarcity, from logistical relevance, without needing the commodity itself to keep exploding forever. I have always liked toll collectors more than heroes. Heroes make headlines. Toll collectors make money. When the world becomes uncertain, infrastructure that remains necessary often gets more valuable, not less. That is why I prefer those parts of the chain. They give you exposure to the importance of energy without demanding that you perfectly predict every move in the barrel price itself. Now let us move to defense. This is more obvious, which means you must be more careful. Conflicts change spending priorities. That is real. Governments do not quickly forget security shocks. Supply chains, munitions, logistics, transport, aerospace, surveillance, and system hardening all tend to remain relevant longer than the public initially imagines. That is bullish for certain areas of the sector. But the obviousness of the theme means much can get overpriced quickly. So I prefer discipline here, broad exposure where appropriate, careful valuation attention, no emotional hero worship of the ticker that the television keeps mentioning. This is not a movie. It is capital allocation. Now comes the more uncomfortable area, consumer discretionary. This is the kind of place the average person cannot emotionally imagine touching in a war. And oil shock because it feels backward. Good. Backward is often where the money is once panic matures. If the sector has been sold to extremes, and if the policy response begins easing financial conditions later, then some of the most hated areas can produce the most violent upside. Not because life is wonderful, because the price already assumes something worse. The market does not need everything to get better. It only needs conditions to become less catastrophic than the pricing implied. That is where oversold sectors matter. Now, I am not telling you to buy any old retail story and call it genius, far from it. I am telling you to separate structurally damaged businesses from temporarily crushed pricing. An airline with direct exposure to fuel costs is a very different case from a strong discretionary company sold in generalized panic. A weak bank with rate and credit stress is a very different case from a financially resilient software platform pulled down by indiscriminate selling. This is why analysis still matters. Panic creates the opportunity. Discrimination captures it. Then there is software and selected growth. Again, this sounds strange to people thinking only in headlines, but if the sell-off is broad enough, liquid enough, and driven enough by generalized fear, then even secularly strong businesses can get marked down harder than their real impairment deserves. That does not mean buy everything. It means recognize the difference between a war destroying the economic foundation of a business and a war causing a market-wide liquidity event that pulls many good things lower with the bad. That distinction is everything. Now let us return to gold for one final time, because I do not want to leave that thread hanging. Gold is not invalidated because it sold off in the wrong phase of a panic. If anything, you could argue that the very fact it was hit by liquidation while its long-run thesis remains tied to debt, currency distrust, reserve behavior, and eventual policy response makes it more interesting, not less, for patient capital. The market often does this. It humiliates the right long-term asset in the short run so that weak holders can be cleared out before the real move begins. That is why I refuse to read one ugly week as a full philosophical verdict. I care more about the next phase than the last one. And the next phase, if this sequence continues, is policy response. That is where the biggest money usually lives. Now let me give you 3 rules, because when markets become this unstable, rules matter more than opinions. First rule, do not chase what already had its obvious move. If everyone can already explain why it went up, you are probably late to the easiest part. That does not mean there is no more upside. It means the asymmetry has changed. Second rule, watch the bond market more than the television. The bond market will tell you when the fear shifts from inflation to recession, and when that shift becomes clear, the policy response trade begins. Third rule, protect your balance sheet before you try to be clever. No leverage if you can help it. No heroic all in bets. No pretending you are a genius because you have a strong opinion in a highly nonlinear event. The first job in a crisis is survival. If your capital structure is weak, even the right idea can still destroy you through timing. I have seen more intelligent people ruined by leverage than by ignorance. Now let us widen the lens. Every major oil shock in modern history did 2 things. It punished the unprepared, and it created extraordinary opportunity for the people who understood what the shock would force governments and central banks to do next. That was true in the 1970s. It was true around the Gulf War. It was true in later crisis periods where panic selling and policy response combined to create huge dislocations. The script is never identical. The mechanism always rhymes. Panic destroys confidence. Liquidity gets sold. The market overshoots. Policy shifts assets that were sold hardest, despite remaining structurally alive, begin repricing violently. The people who waited for emotional comfort arrive late and tell themselves they were prudent. The people who accepted uncertainty earlier get paid. That is not a slogan. That is how markets transfer reward. Now, I am not naive enough to tell you the exact bottom is in. That is not my job. That is not anyone as honest job. The market may want one more flush. Oil may go higher before it goes lower. The strait may get scarier before it gets calmer. Diplomatic signals may appear and vanish and reappear again. That is what real crises feel like. Messy, nonlinear, hostile to clean narratives. But none of that changes the central idea. The great opportunity is not the war itself. The great opportunity is the policy panic the war may force. Once you understand that, you stop staring at the explosion and start watching the pressure in the machinery around it. You start watching yields, liquidity, policy language, support measures, positioning. You start separating structurally damaged assets from emotionally sold assets. You stop asking only what is happening. You start asking what happens next because of what is happening. That is how serious capital thinks, and that is the difference between reacting to headlines and positioning for wealth transfer. So let me end as plainly as I can. Oil can go much higher. The stock market can get hit much harder. Gold can remain ugly longer than people expect. All of that is possible. But if the bond market keeps moving toward recession fear and the policy machine begins preparing its next support cycle, then some of the biggest opportunities of the year will not come from the obvious war winners. They will come from the things panic sold too cheaply before the crowd realized authorities had no choice but to move. That is the window I care about. That is the mechanism I want you to understand. And that is why the biggest mistake you can make now is not simply to panic. It is to confuse the first phase of the crisis with the whole crisis. The first phase is liquidation. The second phase is policy response. The third phase is repricing. If you only understand phase one, you will sell the wrong thing. If you understand all three, you have a chance to stand on the right side of a very expensive transfer. That is the whole game. Not courage for its own sake, not dramatic predictions, mechanism, positioning, and enough calm to let the market show you when fear has shifted from inflation to economic breakage. Because when that shift becomes undeniable, the move that follows is usually far larger than the move that frightened everybody in the first place.